Hi, we're working on the Chapter 16 homework, and it's just like problem 16-15 in your book, except yours will be in Connect and it will have different numbers. All right, so I've decided to use Excel for this one, and I've pre-filled in a lot of the numbers from the balance sheet. So I'm going to share my screen with you so we can look at that balance sheet and in the income statement. And then we can also look at the Excel spreadsheet with the problems, and we'll just solve them in the spreadsheet. Okay, so I just need to stop here and share my screen. Sharing. All right, looks like we're shared. There we go. So I'm just gonna pop out here to show you. So here's the numbers for the problem, right? So your problem has some instructions too, but this is the financial statement. So we've got a balance sheet with 2 years, this year and last year, and we've got an income statement and with a reconciliation to the retained earnings. So that's nice because it does have the dividends. So it's got our retained earnings statement kind of built in there. So that's helpful. And in the instructions, it gives us a few other items that we might need to know. So as those come up, I'll tell you about them. But yeah, so this is what we're going to do. We're going to take these numbers from this financial statement, and we're going to turn them into some ratios and talk about them a bit. So I've set up this spreadsheet. So the problem itself has 3 parts. The first part asks you for some debt management and profitability ratios. So here they are, and I've pre-filled in the numbers from the financial statement. So here's earnings before interest and taxes, EBIT, and if you look at the financial statements, you'll see here it is, the operating income, right? So it's going to match up, right? There it is right there. Right, so I'm just taking these numbers off of here and plugged them in here. Interest expense, so that's going to be right below. Yep, there it is, interest expense. See? So I've taken these numbers and put them in the spreadsheet so that it's just easier to do my calculations. But so the numbers that you need come from for times interest earned, these numbers come from the income statement only, right? So there's no need for that balance sheet yet. So to calculate times interest earned for this year, right, it's simply equal to earnings divided by the interest expense, right? And so certainly you can round 4.33, and that's it. So you're covering your interest 4 1/3 times. So how about last year? How do we do? So that's equal to, again, earnings before interest and taxes divided by your interest expense, and that's 3.4. So there's your answer right there. Times interest earned for this year is 4.33, and for last year it was 3.4. So we've although our interest expense increased, we had more earnings before interest and taxes, so I guess that's a good thing. So the next thing in section 1, part B, it says calculate the debt to equity ratio, right? So the debt to equity ratio is nothing more than total liabilities divided by stockholders' equity. And all I did was go over to that balance sheet, right, and get, so here's your balance sheet, right? So here's your stockholders' equity, and here's your total liabilities for each year, and they are just plugged in over here. And to calculate it for each year, I just take liabilities, divide them by stockholders' equity. So this is equal to my total liabilities divided by my stockholders' equity. And there you go, 78%. I'm just going to go 0.78, right round to 2 places. Same thing over here. You just divide total liabilities by stockholders' equity. So total liabilities divided by stockholders' equity is equal to 0.63. And again, that's just a formula. I mean, they're very simple formulas. There's nothing very complex. I guess knowing where to get the numbers is probably the biggest thing. But they're pretty clearly labeled on those financial statements. So that's not hard. So again, on to the next thing. So number C, 1C asks you calculate the gross margin percentage. So we know the gross margin and we know the sales. Those are over on the income statement. Just take a look, right? So here's your sales. Here's your gross margin, right? Sales, gross margin, sales, gross margin. So we get those numbers and we bring them over here. And to calculate gross margin percentage, right, what percentage is the gross margin of our sales? So you just take gross margin divided by sales, right? So that's equal to gross margin divided by sales. So that's 20%. And this one is equal to gross margin divided by sales. So that's 20 2/3%, 20.7%. All right. So that's the next one. D says calculate the return on total assets. Now the thing about return on total assets is you've got to get your average assets and you've got to get your after-tax cost of interest. All right. So this formula, all right, is going to calculate your net income, right, less, you add back in the total cost of interest, I guess I should say, right? So after tax, right? So you have to have your tax rate, which is 30%. So here in this case, we got our interest expense right off the, we got our interest expense right off the income statement for both years. It's 360. Well, actually, we already had it, didn't we? But it was 360 for current year, 300 for last year. And the tax rate, I think they tell us in the problem somewhere. 30%. If you look on the income statement, sorry. If you look on the income statement, there it is. Income taxes are 30% for both years. All right. So to figure my after-tax cost of interest, right, I have to take 360 times 1 minus 0.30 or times 0.70, right? And so that is equal to 252,000. Oh, it's already in there. I'm sorry. All right, it was already in there. There it is. I already calculated it. I thought I was calculating it for you. So 360 times 0.7 is equal to 252, and 300 times 0.7 is equal to 210. So that's our, we're adding back in the after-tax cost of interest to our net income, because that's what that's doing is stripping out the cost of leverage. So if you have a company that's not very leveraged, they won't be paying very much interest. So you're trying to compare this return on total assets by taking out that interest expense. Or I guess I should say not taking it out, really adding it back into net income. So this then is the total, right? So that's equal to that plus that. So right, you take your, oh, this has got a $sign in front of it. It thinks it's a string. All right. All right, that's more like it. Okay, so equal to this plus this. All right, so we get 1,092,000, right? So that's our net income with our interest added back for current year. And this is equal to our net income plus our interest added back. Oh, again, it thinks that's a string. So our net income plus our recalculated interest. Okay, now I don't know, there must be a space or something. Space here. Oh, I think there's a space there. Yeah, okay. All right, so 714 is the number. So here's our net income with the interest added back in, right here, okay? So to get our return on total assets, we want to look at that, our return, our net income plus our interest expense added back, divided by our total assets. But we use an average of the total assets, right? So we have to take this year's plus last year's, add them, divide by 2. And the book tells us that for previous year, right? So if this is year 2, if this is year 3, this is year 2, and this would be year 1. So in year 1, it tells us total assets at the beginning of last year. So you have to look down there in D where you're doing the calculations, and it tells you what they were, 12,960. So the total current assets, total assets here and in year 1 are 12,960. And then of course 000. So 12,960, 14,880. So we've got all our years, right? So year 3 plus year 2 divided by 2, right? Year 3 plus year 2 divided by 2 equals to 15,990, right? And then year 2 plus that one we added, right? So we didn't know, but in the book it told us this 12,9. So we take that last year's beginning plus previous year's beginning, divide them by 2, and so our average is 13,920. Oopsie. There we go. So here's our average total assets. So now we take the average total assets and divide it into that net income, that recalculated net income, right? So 1,092,000 divided by 15,990 and 714,000 divided by 13,920, and that's our return on total assets. So equal to this divided by this. So our return on total assets is 6.8 in the current year. And for last year, that net income plus interest divided by average total assets is 5.1. So we're doing a little better return this year. So we're improving year to year, it looks like, right? In several areas, times interest earned. All right, so the last one it asks for in part E, it says the return on equity. So that's what we got to calculate. So again, this is one of those deals where you're taking an average, right? The this year's beginning and this year's ending divide by 2. And of course, this year's beginning is last year's ending. So I need that year 1 again. So if you were come out here, right, and look at the equity, right? That's what we're looking for. Looking for the equities, right? So here's this year's ending and this year's beginning. So you add those, divide by 2, you get this year's average. And then they had to tell us the total assets at the beginning of last year were 12,900. I'm sorry, total equity stockholders' equity at the beginning of last year totaled 9,048, right? So 9,048, and then 000, right? So we've got our 3, so we can get this plus this divided by 2, and then this plus this divided by 2. So if you come look over here, I did that. I'm sorry, I did that right here. So that this year's beginning equity, stockholders' equity, this year's ending was 9,600. This year's beginning was 9,120 divided by 2. So average stockholder equity for this year should be 9,360,000. And for the previous year, right, you take the one that they gave you, the 9,048 plus 9,120, divide it by 2, and that is 9,084,000. All right, so there's our average stockholder equity. It's always beginning plus ending divided by 2. And always remember, previous year's ending is the new year's beginning. All right, so now to get our return on equity, we just take our net income and divide it by our equity, our average equity, average equity. So that's equal to net income divided by that. Oh, there's a string. All right, and we'll do the same thing here. So this in the previous year, that's equal to the net income divided by the average total stockholders' equity. So we've got 9. I guess I call that 9%, and I guess I'd call that 5.6%. So that's what we got there. Okay, that's great. So we calculated part 1, A through E, and we did have to calculate some averages. So always remember, when you do average total assets, average stockholders' equity, anything like that, it's the beginning balance plus the ending balance divided by 2. It's not a perfect average. If you took every day's average, it probably wouldn't be perfect, but it's close enough. All right, I mean, think of how many things are estimates. It's definitely close enough. All right, so whenever you do an average, beginning plus ending divided by 2, and don't forget, when you're doing your return on total assets, you have to add your after-tax cost of interest back into net income. I'd say those are the trickiest parts here. Okay, so the question has a part 2, all right, and it asks you to assess the stock market performance, right? So you're going to look at things like EPS and dividend yield ratio and things like that. So we're going to do some calculations based on those formulas. So it tells us, so we need a little more information than is just contained here, right? Because if you're looking at things like the stock market, you need to know what the price of the stocks are, right? So we know it also is giving us a few other things to look at here, right? So things we're going to need to know is the stock price, and they tell us that for the end of this year, it's $72 per share, and at the end of last year, it was $40 per share. All right. And I'm going to come look over here and see, okay, so net income, right? We know that. So we're going to, first of all, we're going to calculate earnings per share. All right. So that's what we want. We want to know the earnings per share. Well, that's simply net income divided by the number of shares. And in the problem, I could not find, I don't know if this is supposed to be part of the problem or not, so I don't know if in Connect you'll have to do this, but I couldn't find the number of shares, so I had to calculate it, right? So when I was looking here, so normally you'll see something like, normally on an income statement, down here below net income, they'll usually tell you earnings per share, but they want you to calculate it, right? And usually up here, where it says $78 par value, well, usually they'll tell you how much stock is outstanding, but they didn't. And in this problem, one of the things they tell me, as we're looking at it, we're comparing this company, we've got the financial statements, and one of the assumptions I'm supposed to make is that common stock hasn't changed, right, over the last 2 years, right? And I can see that it hasn't. And so they haven't issued any, they haven't bought any. So here's $78 par value, and my equity, my common stock account balance is $7,800,000. So if we haven't done anything to the stock, if nothing's changed, there's still the same number of shares outstanding. So what I did was I just took the 7,000,008 balance from the common and divided it by $78 per share, right? Because that's what they're telling me. There's no paid in capital in excess or anything like that. So I just go, there's my common stock balance, there's my par value, and so it's 100,000 shares. So that's what we got, right? So the average number of shares outstanding is 100,000, and we need that if we're going to calculate things like earnings per share and payouts per share, things like that. So we got 100,000 shares outstanding. All right, so that's what we need. So that's all we need really to do earnings per share, right? We got our earnings, got our number of shares, so we just divide them. So for current year, that's equal to the net income divided by our 100,000 shares, so $8.40. For previous year, equal to our net income divided by the shares, and that's $5.04. All right. So and just how I got this number of shares was I did this, right? I took my common stock, divided it by the par value, and that gave me the number of shares. All right. Maybe in your problem it'll tell you that, but I could not find anywhere that it told me the number of outstanding shares, even though typically on a balance sheet it would tell you how many shares are outstanding. All right. Or it would just tell you the earnings per share. And then you could back into how many shares were because you'd know the net income and the earnings per share. Anyway, neither here nor there. That's how you're going to have to do that, I think, is calculate your earnings per share, your average number of shares. All right, so next we're going to look at our dividend yield ratio, right? So we want to calculate this guy, dividend yield ratio, right? And to do that, to get this dividend yield ratio, I need the market price per share, which they told us in the problem. They just tell us. Stock price at year end of this year is 72. Stock price at end of last year is 40. So we got those here. But you need to know the dividends per share. All right. And what they gave us on this income statement was the dividends, right? So these are the total. Well, that's not a very good line, but there you go. For this year, it's 360. For last year, it's 252. All right. So that's pretty easy to turn into dividends per share because we got a nice round number, 100,000 shares. So 360, right? So we're down here now. 360 divided by 100,000 is equal to $3.60 per share. And the previous year, our dividends we paid out was 252. So it was 252,000. So that's $2.52 per share. So there's our dividends per share. So everybody who owned stock got this much for each share. And to calculate our dividend yield ratio, we just take the dividends we paid per share divided by our price per share. Easy peasy. So this is equal to this divided by price per share. There you go, 5% dividend yield ratio. Last year, we had dividends of 252. So our dividend yield ratio is equal to the $2.52 that was paid out per share divided by the $40 it cost you to buy a share, $6.30. So that's pretty good. Oh, the answer's in there. All right. So the next thing is dividend payout ratio, right? So that's simply what part of the earnings per share get paid out as dividends, right? And so we already calculated earnings per share up here, right? 840 and 504. We've just calculated dividends per share, right? And so now we just take those numbers and use those. So dividend payout ratio is dividends per share divided by earnings per share. So dividends per share of 360 divided by earnings per share of 840 is equal to 42.9%. And in the previous year, our dividends of $2.52 get divided by our earnings per share of $5.04, and that's 50% dividend payout ratio. Great. So now that we have our earnings per share from up here, we're also gonna, this is a very popular calculations, the PE ratio. That's a very popular one. And all you do is you take your market price per share and divide it by your earnings per share, right? So in other words, how many times earnings are you paying to buy a piece of stock, right? If you only thought it was worth what they earned this year, you'd only pay $8.40. But you think they're going to keep doing better, so you're going to pay several times the earnings, right? And in this case, the PE ratio for the current year is equal to what we pay per share, which is 72, divided by our EPS, which was 840. So I'm just going to round that to 8.57. All right. So we're going to pay 8.5 times the earnings to buy that stock. And over here, that's equal to the $40 per share we paid last year divided by the $5 per share we earned last year. So that's 7.94. All right. So last year we were only willing to pay 7.94 times earnings. So, you know, we're going to pay a little more now. I guess that's good. What's the book value per share? So remember, assets minus liabilities equals stockholders' equity. So we take that and we divide it by the number of shares. And so it's just kind of like, what would you get per share of what's left over after you paid off all the liabilities? All right, so that's just equal to the stockholders' equity, which we already know. They just got that from the balance sheet, and the number of shares. So it's pretty easy. Stockholders' equity divided by how many shares you have is book value per share. So equal to stockholders' equity divided by our shares. And so for the current year, the book value is 96. And the previous year, we had stockholders' equity of 9.1 million divided by our 100,000. So that's only 91.20. So this is kind of interesting. This is kind of indicative. So if you look here, what people are paying for this stock is $72 per share and $40 per share. but its actual book value is $96.91. So people are kind of not thrilled about this stock. And in your book, we'll go over here and look at this. If you look here, they're giving us some financial ratios that are typical for companies in this industry, right? So if you look, you see how this PE ratio is 10, right? Well, our PE ratio is only 8.57. So this company is not earning as much, right, as others per share. So they're not, people aren't too happy with them, right? So if you look at these other ratios, we haven't calculated, I don't think we've calculated these yet, but they are starting to not look as good as the industry. So maybe the market value, right, that what they're willing to pay for a share kind of reflects our future earnings expectations. In other words, we don't think they're going to earn as much as the other people in the industry because they haven't been. So, we don't want to pay as much. So we're paying less than book value. Okay. So part 3, you have to do some liquidity ratios and asset management. So there's A through G. And it starts out with working capital, so calculating the working capital. So I've already put these numbers in if they were on one of these. Yeah, so I just went over to the balance sheet and got the assets and the liabilities, right? So working capital is current assets minus current liabilities. So working capital in the current year is current assets minus current liabilities. Oh, we got that $sign in there. Nope, I don't know. Maybe there's a space. Oh yeah, there's a space. Okay. So it was thinking it was a string again. So that minus that. There you go, 3,000,009. So our working capital is 3,000,009 this year. And in the next year, previous year, our working capital is my current assets minus my current liabilities is 3,180,000. Okay, so we're able to cover our current liabilities just fine. So I don't know, people don't like this company. I guess they don't have as good of earnings because they've been looking okay on a lot of stuff. All right, so the current ratio. All right, instead of taking assets minus liabilities, we're going to take assets divided by liabilities. Right, so it's the same numbers, but we're going to divide instead of subtract. So equal to 8 divided by 3.9. And we got a 2. So we're covering, we have twice as much, and you could tell from looking at here, right? Because these numbers, 3.9 and 3.9. So you'd had twice as much working cap, you had enough working capital to cover liabilities twice, and that's telling you I have enough working capital to cover liabilities twice. And so this is equal to current assets divided by current liabilities. I have enough working capital to cover, last year I had enough working capital to cover current liabilities 2.15 times. So not quite as good a position in terms of, but not like horrendous. All right, and then there's this acid test, or what they call the quick ratio. So instead of using all your current assets, right, you use current assets minus prepaids and inventory. So let's look over here, see what I'm talking about. All right, so if we look at our current assets, you'll see that we've been using total current assets, right? Well, some of those total current assets are prepaid, like prepaid rent, prepaid insurance, and some of those are inventory. So we want to subtract these out of the current assets and see, as far as our actual true liquid assets, right, what's up, okay? So that's what the quick ratio or the acid test ratio is about. So to calculate our quick assets, right, we take the current assets, right? So there's current assets, that's 7.8 million, minus the prepaids, minus the inventory, and for the current year, that gives us this 3,660,000. For the previous year, we took our same current assets we've always had, minus our prepaids, minus our inventory, and that gives us this 3,360,000. So we got a smaller set of assets to work with. Our current liabilities are still the same. We still have to pay them back out of our current assets, but now we're saying, can we pay them back when we exclude inventory and any prepaid, things that aren't really as liquid, right? Because your cash, your accounts receivable, and your marketable securities, those are very liquid. Those are actually going to become cash within 30 days. Prepaids never really become cash, and inventory, you know, we haven't really figured out average sales period, so I don't know how long it takes that, but we're going to, it's down here. So anyway, back to that quick ratio or the acid test ratio. So now I just take I do it the same as like my current ratio, but it just has fewer assets, right? So I take my quick assets, divide them by all my current liabilities, and now we're at 93%. Oh, that's a big deal. 0.94. So now I see why they're not as thrilled about these guys. These guys are not super liquid. Okay, equal to 3.3 million divided by 2.7 million. Okay. And so 1.22. So they were more liquid last year. All right. So yeah, they something's going on with their liquidity. They don't have as much cash. So that's probably some of why people aren't that thrilled to invest them. All right. So the thing to remember about acid test ratio is you take your current assets, but you subtract out, right, prepaids and inventory. So it's really just a more true liquidity test, because you really don't repay your current liabilities out of your prepaids. And even, you know, depending on how well their stuff is selling, maybe you don't pay it out of your inventory either. So we need to keep an eye on that. Okay, so there's our liquidity ratios. And that information. So we were looking at receivables are part of our liquidity, right? We plan on them turning into cash within about 30 days for most of these kind of things. Do they? Let's see. What could we do to figure that out? Aha, average collection period, right? We can get the account receivable turnover and the accounts receivable average collection period. So let's do that. All right. So that's part D, right? So in D, it asks you to calculate the average collection period. Okay, so to get the average collection period, we have to do the accounts receivable turnover first. All right, and accounts receivable turnover is nothing more than sales on account, right? So and in this example, all the sales are on account. So if you were to look back over here at your income statement, see how it says all sales are on account? If they didn't tell you that, they would have to tell you something like how much of the sales are cash, so you could subtract, right? You know, you had to be able to figure out how much of the sales are on account. And for this company, they're all on account. So our sales revenue is our sales on account, right? So we need our sales on account and our average receivables. So remember, average is ending account balance plus beginning account balance divided by 2. And in Part D, they tell you that this year, or the year before last, the receivables are 2.420 million to 420,000, right? So they tell you that, right, so that you can calculate that, right? So this year plus this year divided by 2 is the average for this year. This year plus that year divided by 2 is the average for that. So you still have to do your average, all right? So there's our average accounts receivable for those 2 years. Now, you take your sales, divide it by your average account receivable, and that's your receivable turnover. Right, and you do it for both. Right, and so there's your receivable turnover. How many times you collect them in a year, basically, is what we're saying, 7.43. So we aren't doing quite as well. Let's see how many days that turns out to be, right? So if this is how many times you do it in a year, right, you just take 365 divided by 7, and that tells you how many days, right? And so that has to be 52.1 and 49.3. So that is kind of a long time for receivables. And that is where this liquidity problem is coming up right here. So that is telling us a lot more. They are receivables should be coming at, I would say, at the latest 30 days. So are they selling to people who can't pay? Have they changed their credit policies to let more people so they can get better sales, right? Because one way to increase sales is to loosen up your credit policy. So if you're having some problems, you can loosen up your credit policy and get more sales, but then you have this collection problem because you're letting kind of sketchier people have receivables. So this is looking to be like kind of some of the issue. Okay, so part E, it's asking us to calculate the average sale period. Oh, I'm sorry. No, that's not the right one. 15. Okay, sorry. For E is asking, oh yeah, it is asking us for the average sale period. So again, this is another one of those things we're doing average, right? Average inventory this time, right? So average inventory balance, right? Well, to get average inventory balance, you have to take beginning inventory balance plus ending inventory balance divided by 2. And again, so I'm taking this plus this, because last year's ending is this year's beginning. This plus this and divide it by 2. Then this plus the one they give me. So in that problem, it tells me accounts receivable at the beginning of last year was 1,560,000. So 1,560,000. So 2,000,004 plus 1,560 divided by 2, right? So you get your average inventory, which turned out to be 3.15 million and 2.16 million. Right, so we take our cost of goods sold, which just comes right off the income statement, right? Right off the income statement. And take cost of goods sold divided by that average inventory balance we just calculated. And it turns out to be 4 for the inventory and 4.6 for last year, right? So for this year, inventory turned over 4 times. Okay, 4 times. So but like imagine, it's not really how it worked because it's kind of a continuous process, but you can imagine we put inventory in the warehouse, sold it all, more inventory, sold it all 4 times. We went through our inventory 4 times. So what does that mean in terms of a year? How long does it take me to sell all my inventory? Well, right, if it's a 12-month year, so you're talking about 3 months. So so you take 365 days divided by 4, right? So 365 divided by 4 is 91.3. So yeah, about 3 months. And 365 divided by 4.6 is 79.3. So it's taking us longer to sell stuff. So is our inventory getting obsolete or stale? Is there something going on? I don't know. But these are things I'd want to look into. We aren't collecting as fast. We aren't selling as fast. It's like something's slowing down with us. All right. So now that we have our average collection period, right? And now that we have our average sales period, okay, I don't want to do that. I was just wanting to highlight. Right, now that we have our annual sales period, now we can tell an operating cycle, right? So in other words, from the time I purchase some inventory, right, through the time I get it paid for by my customers, how long is that? So I add my sale period plus my collection period, right? So from the time I get that inventory to the time it gets paid for, how long is that? Well, 91.3 plus 52.1 is 143.4 days this year. Last year, 79.3 plus 49.3 is 128.6 days. So see, this is where that cash crunch is coming in, right? This is why we're not very liquid. All right, so that's a problem, right? Well, anyway, let's do, we could still have one more thing to do, right? So what's our asset turnover, right? And asset turnover is nothing more than sales divided by asset. So 0.99, right? And 0.9. All right. So that's all the calculations they ask us to do. The problem does go on and ask you to prepare a brief memo, how they're performing relative to competitors. So if you look down here, this tells us the industry averages, right? So if you're going to take these numbers we all just calculated and compare them to these. Like look at this average collection period, 30 days compared to our, what is it, 52 days. Yikes. Sales period, 60 days. Ours is 3 months. So yeah, so I can see why people are not liking us that much. So what you want to do with that part of the problem, I guess they ask on Connect, you just type in a little bit. Our share price increased, so people don't hate us, right? But our PE ratio is worse. So we're doing sort of okay. Like if you look over here at times interest earned, net income, right? So if you look at return on equity, some of these things are kind of good. At least we're doing better than we did last year. So comparing comparing this year to last year, we are improving in some important areas, but in some others we're getting worse. So I don't know how sustainable those improvements are going to be, right? If our operating cycle is half the year, or almost not quite half the year, but it's a pretty long time. Well, that's going to be a problem if that's not the case for our competitors. So that's how you do that problem. And guess I'll stop sharing that and say good luck on doing that in Connect. And we'll see you at the next chapter.